Hello and welcome to Strategic Alternatives, the RBC M&A podcast. I'm Vito Sperduto, Global Head of Mergers and Acquisitions. And as always, I'm joined by Larry Grafstein, Deputy Chairman of Global Investment Banking. Hi, Larry.
Great to be here, Vito.
And today we have a special guest. We have Josh Rosenbaum, Global Head of Industrial and Diversified Services here at RBC. Josh is back in New York, fresh from our Global Industrials Conference, where we had over 100 corporates representing a broad spectrum of industrial sectors. Also, we are excited to have Josh here today because he's written the authoritative book on investment banking called Investment Banking, Valuation, LBOs, M&A, and IPOs. Well, welcome to the podcast, Josh.
Thanks for having me. Very excited for our discussion today. It's a pretty interesting time in the markets and in industrials specifically.
Josh and Larry, if we think about the M&A market this year, obviously the first half of this year was basically equivalent to what we saw in the second half of last year when volumes have been significantly depressed. We were expecting an uptick in the second half of 23. It's starting a bit slower, I would say, than what we were anticipating. But we are seeing some green shoots and probably more than some green shoots at this point. And although volumes are off, depending on which market we look at globally, 25 to 30% versus what we saw last year to date, it is steadily getting better as we go through the year. So, Josh, maybe we can start off in your sector. Give us a little bit of an overview of where you're seeing pockets of opportunity, some of the transaction highlights, and we'll get into a bit in terms of what we're expecting for the remainder of this year and as we go into next year.
Yeah, well, even more so, now that we're in Q3 heading into Q4, there are very strong undercurrents. People want to do deals. And I think whereas the beginning of this year, there's a ton of macro uncertainty weighing over everyone in terms of trying to figure out where financial performance and cash flows of buyers and sellers were going to go, in addition to high rates. Now, a lot of the macro, at least the fear of the apocalypse, has been removed, but we're still dealing with higher rates. And that's simple math. Higher rates means a higher cost of financing, which impacts buyers' ability to pay. Clearly, some parts of industrials are more cyclical than others, but by and large, you were dealing with companies with real profitability and real cash flows. So the art of the possible should be present in industrials as much as any other sector. But in order to bridge the gap between seller price expectations and buyers' ability to pay, clearly interest rates are a key component. And the health of the financing markets has definitely improved, but we're still talking about hundreds of basis points, depending on the credit rating and the issuer, higher than where we were before. So I think once people are adapting to new interest rates, and I think that bodes well for getting deals done. But once you get into the realm of private equity, which is so dependent on debt financing and the cost of that debt, it does impact private equity's ability to pay.
And Josh, one of the great things about having you on at this kind of inflection point, not just in the M&A market, but in the interest rate cycle, is that your industrial sector covers such a broad spread of industries and really in the global economy. And I want to just ask you, do you feel that your sectors are being uniformly affected? And do you see a general consensus among corporate decision makers and private equity investors about where we are in the cycle and their degree of confidence in not just deal making, but in the economy more generally?
It's pretty uniform. I'd say all subverticals and industrials are hanging in there, frankly, probably more resilient than 99.9% of the people, just given the macro outlook at the beginning of the year, would have thought. Once you get into auto and EV and all the various moving pieces there, that's kind of its own ecosystem. So I'll put that to the side. But whether it's, building products and construction, chemicals, packaging, aerospace and defense, transportation and logistics, and so on, pretty much all of them are hanging in there. If you look at the number of names that were problematic or had heavy headwinds, barring, I'd say, really exuberant, bullish years, it's pretty middle of the fairway. You have a bunch of people outperforming, some underperforming, some kind of, within the bandwidth of normal performance. So I think that's all good. That's all healthy. I think the macro and the performance is good. Balance sheets are good. The problem with industrials, because industrials does generally have healthy performance and balance sheets, is mathematical. It is just the cost of financing. And when the cost of financing a deal, this is a pure hypothetical, for years was 5 to 6%, and now it's 8 to 10% or greater, it just affects things. But I will say, to me, the biggest difference is how the companies in the industrial sector have hung in there and how kind of the threat of a macro apocalypse is being removed. So now it's just threading the needle on valuation.
Yeah, that's encouraging.
And Josh, as you're watching them perform, through this time period, if we think about the COVID time period, the last 2 or 3 years, I would say we've always talked about how so many of our clients have been inwardly focused. And I think they're probably as clean as we've seen them in some time in terms of the strength of their business. And so it does feel like there's a pent-up demand where they're ready to transact. Are you seeing more activity in terms of where your clients are looking at transactions in terms of additions, or have they thought about, when the time is right, I have an asset that I know I need to sell as I'm shaping my portfolio?
Well, Vito, I think it's both. We just had our annual industrials conference last week, so we met with a broad swath of companies, C-suite. All of them say they're open for business on M&A. I can't even tell you definitively that it's more bolt-on, has to be middle of the fairway. I'd say it probably tilts that way, but I don't think people are drawing particularly bright lines there. I think they're willing to be opportunistic, and bet on their business for the long term. I think it just comes down to, the cost of that financing and availability, especially as you go down to single B. It's reasonably healthy for double B. It's more expensive than it used to be. And I grade, obviously, the market's always open. And a lot of the I grade guys, given their size, have a bunch of cash. So that's on the buy side for corporates. They all say they're open for business, looking, to buy attractive assets. In terms of divestitures, there have been some notable divestitures, which I think is a really bullish sign, because if you had a truly, a closed M&A environment, people would just be holding back and say, what, I'll sell when the sun's shining a little brighter next year. We just helped a private equity firm buy an asset, Delrin, from DuPont, pure corporate divestiture to thread the needle. DuPont had to keep some of the equity. There's some seller paper involved, so people being creative. Another notable deal in aerospace and defense, BAE Systems, major divestiture out of Ball. So things are happening. And to me, that's encouraging, because as I said, we've all been through environments where it was just shut, and corporates that had businesses they were dying to sell, being pressured to sell, just said, there's just we can't do it. And all of us that read the paper, there are other rumored deals, including in industrials, coming of size.
And look, I think you mentioned the Ball Aerospace transaction where BAE was the winner of that auction. I would say that's an asset that has been coveted for some time over the years, well before COVID. And certainly it's something that everyone tracked and talked about. And at the right time, when it became available, as we always talk about, good premium assets will have a market. And that one certainly did.
Well, it's also true that we had 15 years of 0% interest rates, plus or minus, but in the era before that, we had a very strong and healthy M&A market in industrials. And that even though, as you say, Josh, the cost of capital needs to reset and people need to rethink their plans based on that, you can still have a very steady and very constructive set of conditions for the right types of transactions.
Right. And I guess, Vito, as a continuation to your question, centered on corporates, definitely appetite to buy. They are launching or have announced successful transactions selling assets. Corporates that have cash, revolver capacity, CP access, they're in a very good position, because obviously you can impute a higher cost to their cash, throw it at a pick your duration treasury rate. But the truth is, if that cash is lying around, and many of them have billions, that's a big advantage versus, a single B issuer that has to issue at 10%, or private equity whose cost of debt will be double digits. Good example, a very good transaction for RBC where we were the sole advisor to Saint-Gobain, buying Building Products of Canada, over $1 billion deal in the roofing space. Saint-Gobain was able to use cash on hand to do it. And it basically convinced the seller that private equity couldn't be competitive. And frankly, neither could even other corporates that didn't have that kind of cash lying around. So it's a really good environment for large corporates with that kind of balance sheet capacity.
It highlights in this environment right now that a lot of our corporate clients who've done well by their balance sheet can consider transformative M&A or opportunistic M&A when it comes up at the right time. And certainly that's going to be something that we see going through the remainder of this year and the early next year, because I think there's a lot of parties that are prepared based on having delevered and having the capacity, as you talked about. Maybe taking a step back, as we talk to our clients about the different alternatives that they have, I mean, we always go through the analysis of, you're generating a fair amount of cash. How do you use that cash? Do you look at M&A? Do you look at delevering? Do you look at stock buybacks, things of that nature, if you want to continue the status quo? Are you seeing the management teams and the boards aligned in terms of the growth initiatives that they're pursuing? Do they feel comfortable with their businesses? One of the things I'm seeing a lot of is in this environment, there's a lot of talk of specific acquisitions to bolster growth because they're concerned about hitting the targets that they've put out there. So where are your clients in that spectrum? Are they buying businesses to try to bolster growth?
It's not even sub-vertical specific within industrials. It's very company specific, but typically the three highlighted capital allocation areas are organic, buybacks, and accretive M&A. There have been significant buybacks towards the end of year, the beginning of year when stock prices were much lower. So that's been done. Organic initiatives have been pushed. So it stands to reason that as the M&A market is coming back, and by that I mean, like I said, there's just a little more visibility. There's a little more, optimism about the macro outlook. I wouldn't even say optimism. I'd say, lack of doom and gloom. So I think eyes are turning to M&A. It takes two to tango. Sellers need to be willing to sell. And, if they and their advisors are being more honest, in some cases, maybe their expected, prices have to come down. It's really mathematical that depending on the buyer, especially if it's geared towards PE, if, the cost of funding for the buyer is 10% plus versus 6%, then the multiple has to be lower. So there's this recalibration. I think some of that math goes out the window for corporates. If corporates, deem it strategic and they have cash on hand and a cheaper cost of capital, they could stretch more. But I guess now I'm morphing more towards the private equity world. I've seen, very delineated facets within deal making in industrials for private equity tied towards bridging this seller-buyer valuation gap. But I think corporates, again, coming from our conference last week, definitely want to ramp up to the extent that they've been playing more of the buyback and the organic growth arrows from their quiver. I think they'd like to ramp up M&A.
So I have one related question on corporates and the economy, Josh, which is, and again, I know it's a very wide, heterogeneous group of companies in the industrial sector that spans everything from packaging companies and transportation logistics companies to chemical companies, building products, of course, aerospace, et cetera. But we've seen that the United Auto Workers are immersed in a contentious discussion with the big three automakers, and we know that there's wage pressure that comes from just the inflationary environment we've all experienced the last couple of years in the industrial sector. Are there any general observations you have about these types of pressures from wage pressures on margin that might affect M&A, either as positively or negatively? And also, do you have a sense from most of your client base that the types of supply chain issues that created, challenges for many companies in industrials have begun to stabilize at this point?
So yes, across the board, labor scale, which is really interesting because it's, as we all know from our professional lives going back decades, in a tough economic environment, people don't usually talk about labor scarcity. And that's kind of the new normal of this macro environment. We have low unemployment and high demand for workers. There's no doubt there are pressures across the board in industrials to find sufficient and trained labor, probably more so than I've heard in my entire career. So that definitely is affecting performance. To be fair, if you look at gross margins and generally margins, though, they're making it work in the form of price and mix and other efficiencies. But there's no doubt that labor's, I mean, obviously with the UAW strike going on, that is kind of the flagship case out there. But pretty much every subsector of industrials, I spend a ton of time in construction. I hear over and over and over again. And it's from manufacturing line people to truck drivers through the chain in terms of getting the right trained people, sufficient trained people, on board. Which it's a double-sided coin. It tells you that there's real demand, and they're not looking to cut people; they're looking to hire people. The flip side is, obviously those costs have to be accounted for. And then on the supply chain, I mean, there's no doubt this is very, very sub-segment specific on supply chain and onshoring. But there's no doubt people are planning, not for a year or two, but for, what could be decades in terms of the new geopolitical normal. And that means real costs associated with redesigning supply chains, onshoring facilities, onshoring the supply sources. And commensurate with that will be labor, because labor will be needed, with onshoring here in the US versus, in theory, places where there was cheaper labor or cheaper costs. So it does tie together, and industrials is very much, in the middle of all this.
We always talk about the need for confidence in executing on transactions. And it does feel like, and I think your universe of clients is a great example, it does feel like CEOs are much more comfortable that they can manage through disruption, whether it be a geopolitical event, supply chain issues, obviously labor's an issue, but it feels like they've gotten their arms around their businesses. And we've seen a steady uptick in CEO confidence. Are you seeing that level of confidence is at a sufficient level now for them to transact, or is it still case by case like we're seeing out there?
I think there is higher confidence. I think going back to the second half of last year, entering into Q4, the lack of visibility across the board was pretty unprecedented. People really didn't know what to make of 2023. And by the way, they were right. All you have to do is turn on any, I'll be careful here and not name names, but pretty much any experts on the markets in terms of outlook for 23, and 23 has been a very pleasant surprise. So I think the confidence comes from the fact that, like, this scenario heading into the unknown of the first interest rate hike with all this geopolitical noise going on, and how bad this could be, that's been removed. So I think it's not necessarily confidence that they know that there's going to be a step function change up next year, but it's almost like a sigh of relief that, wow, we kind of weathered that, and here we are. We've got 5% short-term interest rates, and you know what, we're okay. So I think there is confidence that, wow, it wasn't the apocalypse. We're out there. Things are a little more expensive. We are dealing with labor and other issues, but we've got this. So, and that comes back, Vito, I think, to your point before. In that kind of environment, when you don't really know on organic and baseline demand for actually, you're not afraid that it's going to fall through the floor, but, kind of where they're in an environment where it could be flattish, I think you do turn to M&A for growth. So I think that is going through people's minds. You know what? My balance sheet's good. The world's going to keep on spinning around. In terms of growth, to really kind of charge growth, I think I should turn to M&A. So I think that sentiment is right.
This is probably the most variability I have seen in my over 3 decades of doing this, where we had such a peak in 21 in terms of activity and in terms of businesses flourishing. Then you've had such a drop, and now it's steadily coming back. I mean, our anticipation is that 24 is going to be a very strong year from a business climate perspective, but also from a transaction perspective. Are you feeling that with the client base as well? Is it across the board, like you were saying, or is it more dominant in some specific sectors?
No, that's my gut. I think that this fear of the macro apocalypse has been removed. There's kind of been this acclimation to this interest rate environment. There's been almost 2 years of relative dormancy, and I think that there is a tremendous backlog of pent-up demand. So I agree with your sentiment. From my career, probably even the toughest periods, you look at the early 2000s, post the dot-com boom, boom bust, and then the GFC, you really haven't seen these markets closed for more than a couple of years. And guess what? When we get into Q1 of 24, it will have been a couple of years. And just in talking to people, there's so much appetite out there. We haven't really focused on private equity. There's been significant, fundraises. We have a lot of fresh capital out there. These are very creative deal makers that are incentivized, to get deals done. And that combined, with corporates who are looking for growth, it is a good setup. I mean, we'll see. The one damper is still rates and inflation are stubbornly high, but especially with a little bit of cooperation there, could be very interesting next year.
Josh, thank you so much for being on the podcast today. Larry and I enjoyed the conversation, and we always enjoy talking to you. Thank you so much.
Thanks. It was a pleasure being here. Look forward to the next one.
You've been listening to Strategic Alternatives, the RBC M&A podcast. Join us for more analysis about what's moving the M&A markets in our next episode. If you'd like more information on the topics discussed today, please contact us directly or visit rbccm.com/strategic alternatives. Today's podcast was recorded on September 18th, 2023. If you're enjoying Strategic Alternatives, don't miss an episode. Subscribe to us on Apple, Spotify, or wherever you listen to your podcasts, and please drop us a review and/or comment.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives. For disclosures, please visit www.rbccm.com/disclosure.